with these video lectures that I'm hosting, what I do for you as the student is I record what we cover. So if there's anything that you want to go back and have a look at, you obviously have access to that resource. So you can use the videos as a way to revise later on. Okay, because we're going through quite a lot of content in one sitting, and we're obviously going through different sections that come up in different chapters, and it might or might not be overwhelming depending on how much theory you've covered and how familiar you are with it. So I don't expect you to have as much knowledge in terms of having gone to the detail, but obviously I am going to be referring to certain chapters in terms of workings and calculations and so on. I won't have time to go through that in detail, but you've still got access to the theory videos, so you can obviously refer to that. But I will refer to some of the theory as we go. Okay, so it's kind of a mix of theory and practical.
I did actually go through. Cool. I did actually go through part of the exam that you gave me, the 2016 one. I did go through part of the multiple choice questions earlier.
All right, perfect. Yeah, great. So, yeah, I mean, that's the focus. That's what we're going to be doing. So, yeah, as I said, you'll have access to the video after tonight, so you can always review the information and you can go through it. I will email you the solution as well. So once we've covered the paper, then I'll send you the workings and you can have a look at that. Okay. Any other questions, or are you ready to start?
Nothing. I'm ready to go.
Okay, perfect. All right, so this is obviously the past paper. I am going to talk a little bit about an exam technique because you'll see the structure for FIN3701 is a bit different to what you've seen before in FIN2601. Obviously, 2601 was mainly multiple choice. Yes, there were some long questions, but it was very limited. So if you think back to FIN2601, the long question was literally like a calculation to work out like the value of equity or something similar. It wasn't a very detailed long question, and it wasn't broken up into separate parts. With FIN3701, the long questions count a lot towards the actual 70 marks that you're going to be getting in the exam. In terms of duration, it's 2 hours. Just manage your time in the exam. The time can be a bit limited depending on how long the written questions are. You'll see when I talk about structure and how to answer the paper, when we get to section B, I'll give you some tips that you can maybe consider when actually generating and creating a solution and answer. Because the thing is, they split it into like question 1.1 or 1.2, 1.3, but there isn't like guidance in terms of steps. So for example, when we look at one of the questions, you'll see it's quite open-ended. So most students struggle with approach. Okay, most students struggle with like, where do I start? Like, what do I do? So I'll show you what you should do in the exam, and then hopefully that'll help you as well. Okay.
Yeah,
so the first bit is obviously multiple choice.
I think that's why I wanted to do these lectures, is because I remember with 2601, that was pretty much what helped the most, was you giving us the breakdown to say, if they ask this is how you look at the question, especially with those ratios.
100%.
Where they're asking like 3 or 4 ratios, like it just gave a really good idea that when you saw it, you thought, okay, well, this is what we've been given, what can we calculate? So that's exactly why I want to do this.
100%. Yeah, great. I do understand what the focus is. I know you're wanting to focus on exam technique and exam past paper, so that's brilliant. So that's what I'm going to be doing with you over the next few days. Okay, so section A, 20 multiple choice questions. Some are quite simple, some require calculations. You'll see when we go through them. Right, section A counts 20 marks. 20 out of 70 is not enough to pass. So you can't rely on multiple choice to pass the exam. You do need to focus a lot on the written questions.
Yeah,
right, so the first
I saw in the 2016 one, that was pretty much half and half.
It depends, hey. I have seen UNISA change their testing slightly. You've probably noticed that in your other subjects as well.
Yeah, no, 100%. I was just saying, I was looking at I actually went through the October, November 2016, the one that you did with Tammy.
Yes.
And I noticed that was 35 and 35.
Yeah, as I said, it depends. That was in 2016. 2017, looking at the first paper, you can see there's very little emphasis on multiple choice.
Yeah. No, 100%. Cool.
Yeah. So just bear that in mind because it's obviously a very practical subject. So when Tammy did it, that was quite a while back. I think she did this course last year, same time as you're doing it now.
Yeah.
So she was one of the students that actually did the weekly classes as well. And then we obviously did some past papers at a later stage. So you'll see the approach hasn't changed. Looking at this paper, looking at the theory, looking at the content, all of that remains the same. Maybe just to also mention something else is that from FIN3601 that the FIN module does tend to have one or two discrepancies in terms of like the way that the question is asked, and sometimes they don't give enough information. But what I do is I'm going to be focusing 100% on the theory in the textbook. Okay, the textbook that you should be using is the same as the one that you used in FIN3601. So you didn't have to buy a new textbook. It's that one with the orange cover. Well, blue and orange. Okay, so I'm
100%.
definitely going to stick to theory because theory is 100% correct in the textbook. And UNISA can't argue or question the techniques that is described and covered in the actual textbook. So that's just something to say up front because I have found quite a few errors, not so much recently, but more so in the past, from like the 2000
second question looks like an error.
Yes, yeah. So some do have problems, some
looks
don't.
Like an error.
The
second one looks like an error.
Are better than previously, so hopefully that continues and hopefully the trend improves. So obviously the FIN modules haven't been very well managed, but more recently past papers have been better. So let's hope this one was just as good. Okay. Right. So when you approach a question like this, you'll see there's four parts, but you'll see they speak generally in terms of the existing machine. Okay. So cell B, Industries is considering replacing its existing machine, which was purchased 3 years ago. So these are things that you should highlight. Why? Because it's part of the calculation. So now we know this is a 3-year-old asset. Okay, timing is important because you may or may not have to work out the book value depending on how much they want in the actual question. Right, then you've got a cost of 1 million. Right, the cost is obviously going to apply at time 0. That's when I purchased the asset. The machine is depreciated 20% per annum. So 20% per annum meaning how many years does the asset have in terms of useful life?
2 years left.
5
or
years.
It's used
so
3.
2 years left, exactly.
Yeah.
That's good. Okay, so total useful life is 5 years. Obviously, they've purchased it 3 years ago, so the asset is currently 3 years old, and there's 2 years left. So those are things that you should be taking note of when you read the question, just in terms of like a overall like picture, like a diagram. Okay, so I'm going to draw a little timeline here, and obviously put in some values. Then they say that it can be sold today at 200,000. So today is obviously 3 years from when I bought the asset. So this would have been now. And I can sell it for 200,000.
Yeah.
Then they say the new machine will cost 750 with 20,000 installation costs and transportation costs. Right, so if you've gone through the theory, you would have seen they talk about adding those costs that are associated with getting the asset in its state where it can be used. So you can't use the asset if it's not installed. You can't use the asset if you don't have it on the premise. So transportation and installation costs.
It's the same as the cost. It's the same as the cost. No, it's the same as the cost. That if, for instance, if it was going to cost you 50,000 rand to remove the thing, even though you could sell it for 200,000, you would need to minus the 50,000 off the 200,000 that you sold it for, because that is basically your cleanup cost. So
Exactly,
it's very similar. Yeah, I've got that concept.
Yeah, perfect. Yeah, so that's something that's important to obviously consider here, because you're going to have to add the 20 and the 5 to the 750 for the new machine. Okay, something else that we should highlight here is the word replace. Right, because there's two reasons or motives that companies use as, so this is theory. Okay, I'm just revising as we go as well, just so you have some of that. So a motive would be replacement, where assets get old and they need to be replaced, or expansion.
Yeah.
The one that's probably going to come up is replacement, and the reason for that is you need to place values on the new and the old. If you're looking at expansion, the old isn't a relevant cost in the calculation. Okay, so when you look at finance, you need to consider the opportunity costs that come with the decision making. So if I make a decision to replace, any costs that affect the asset in terms of the old asset that I'm replacing the new asset with is considered an opportunity cost and will be part of the calculation. Right, and that's why replacement tends to come up more often, because the replacement calculation is a bit more, let's say, longer, and there's more to calculate, versus expansion, where the old asset has zero worth. It literally has no worth. So you would just look at the new. Okay, so that's just something to consider from a theory point of view. Obviously, here I'm dealing with replacement. Okay, I'm replacing an existing machine, so the first option or the first approach is the one that we're going to be using. Then they say the use of the new machine will decrease the working capital by 7,000. Okay, that's important because that's looking at the net working capital. Okay, NWC, the change in net working capital. So we know that there's a decrease in working capital, meaning there's an outflow. Okay, outflow of 7,000 because that's a decrease in the actual current assets and liabilities of the organization. Right. Tax here is actually 29%. Obviously, this is applicable for the CGT.
What is it called? What is the difference between the two types of cash? It's not a relevant cash flow if there's outflows.
Well, relevant.
If there's those outflows.
Yeah, relevant cash flows affect decision making.
Yeah.
So any cash
but the relevant, what is the?
Sorry, yeah.
Okay. What is the cash flow where it's just where you don't have the outflow, so you just have the normal inflows? That's
you have conventional and you have non-conventional cash flows.
That's it. Yeah. Okay, yeah. That's it. Sorry, you mentioned that in the 2016 exam. I just wanted to just get my head. So this would be an unconventional cash flow.
No, because there isn't any further outflows once we've purchased the asset. So looking at what we've got here, it looks.
But doesn't it decrease the working capital by 7,000?
Working capital is only considered when you're looking at the calculation for TCF, INV, and OCF. OCF actually doesn't look at the working capital. It's only for the one. It's for the initial investment.
Okay, cool.
Yeah, so we wouldn't consider this being conventional or non-conventional. We're only looking at calculations relating to the timeline in terms of initial investment, INV, OCF, operating cash flow, or TCF. Okay, so those are the three cash flows that can come up when looking at a replacement or expansion type question. Okay, obviously initial investment is at the beginning, OCF is during, and TCF is at the end. Okay, that's just theory. Right, so now if I'm looking at this question, we've got information relating to now, and we've got information relating to the end in terms of what will happen. Okay, so first question, book value of the existing machine. Right, that's relatively easy to do. So let's go to our
400,000
answer sheet. Okay, you got 400. Great. Let's check if you're right. Okay, so book value is basically carrying value from an accounting point of view, and we calculate that using cost less accumulated depreciation. Right, so this is just basic accounting that we would have to apply
which
here.
Which is 200,000 times 3 gives you 600,000, leaving you 400.
Okay, yeah, we'll check your answer. So, I'm obviously going through the working so you can see how we do the calculation. So you can confirm that you're doing it correctly if you've done it already. Okay, so existing machine, obviously we've got a cost of $1 million, and we're depreciating it 20% per annum, and it's a 3-year-old asset. So in terms of accumulated depreciation, you're going to have the cost of $1 million less depreciation for 3 years, which would be 3 times the 20% per annum times the 1 million. Okay, it's always important to consider this is diminishing balance or straight line. Okay, they didn't actually mention that in the question. Do you see that?
Yeah.
Okay, which is a problem, because if you assume that that was diminishing balance, obviously your answer would be different.
Yeah.
Okay, so something as simple as that, I mean, they should have put that in the question, but they didn't, which is problematic.
100%.
Okay, and that's the type of thing that I'm looking at in terms of like, yes, the questions are fine, but now there's too much of assumptions that are being made by the students when trying to get to the answer. So obviously,
because
I would have worked out straight line first.
Because if you didn't take that assumption, it would have been 666.66666.
Possibly,
which would leave you with a completely different answer to that. Yeah. Because if it's 3 years and there's only 200 left.
Sure. Yeah, but I think you get the idea, right?
Yeah. No, 100%. Okay. Mark,
so
thanks for highlighting that.
Yeah. So 20% times a million is
200,000.
Yes. Okay. So times 20%, 200,000. We've got 3 years worth of depreciation. So 3 times 200 is 600. So your answer's correct. You end up with 400,000 as the book value of the asset. So yes. Okay. You had the right answer. Option 2. Right. Now they're looking at tax implication from the sale of an existing machine. Okay. So when you're selling an existing machine, obviously there's going to be a tax consequence in terms of the CGT that could possibly arise on the sale of an asset. So now I'm obviously going to be selling an asset, and that asset is going to be sold at 200,000. Which is less than the book value, exactly. Right, so less than the book value, which would mean there would be a scrapping allowance here, okay, or a loss that would arise on the sale or the disposal of the assets.
Yeah.
Okay, so question 2. Selling an asset at less than its book value will lead to a loss. Okay, so obviously we know we're selling this asset at 200,000. We know that the book value is 400, so you end up with negative 200,000. Right, if you times that by the 29%, which is what they give you in the question for the CGT, you're going to get...
But wouldn't it be the 20% tax?
29% tax.
It
was 29% in the question.
No, it is, okay, 20, yeah, that's where I worked, okay.
Okay, so there is a 58,000 tax liability or a 58,000 tax benefit. Which one?
Benefit.
Good.
It's a benefit.
Exactly. Okay, why is there benefit? Just to recap theory, right? A loss is seen as a deduction. It reduces your taxable income. It basically allows you to pay less tax. It's a benefit.
Yeah.
2.
Perfect. Yeah.
Number 3, calculate the after-tax proceeds from the sale of the existing machine. Right, now that's easy.
Would be
okay, because you've got the proceeds. We just spoke about that. The proceeds were 200,000. Okay, you know that there is a tax benefit of 58,000. Right, so the net effect, the after-tax proceeds would have been a benefit of 280,000. Option 1. Right, that would be the after-tax proceeds from selling the existing machine. It's just taking your answer from 1 and your answer from 2 and getting an answer for 3.
Yeah, 100%. I'm with you on there.
Okay, great. Next, calculate the initial investment associated with the replacement of the existing machine. Okay, remember we spoke about the importance of this word replacement.
Yeah. Okay, so can I go through this and you tell me? Yeah. Okay. So we're looking at 775,000 as your starting thing for the new machine. That's what the cost will be.
Okay.
Because you've got your 750.
Yeah. Okay. Did you get an answer here, and then we can check it when I go through it?
I haven't actually done that yet, but I just want to actually go through it.
Okay, no problem.
Just to make sure that
let me go through
my
it, and then if you have any
logic is right.
questions, then if you
That my
have any
logic is right.
questions, then just ask me as I go through it, okay? Is that all right?
So would it be, I mean, just for interest sake, it would be 775 minus
the right
200.
approach is to get the formula that you've got in your notes for the initial investment. Okay, so I'm going to go quickly now to my PowerPoint, and I just want to show you where I'm getting this from. This is the first set. Is this set 1? Yeah. Okay, so let me just show you where I'm getting these formulas from. Right, if you look at the first set of notes, the first chapter in the textbook covers relevant cash flows, and they do a calculation looking at TCF, OCF, and all of that. So when you look at this is the format that you would have to use when working out the initial investment. Okay, and no one can dispute the format and the method of the calculation because it's outlined in the textbook. So if you stick to the correct approach, you're going to get it right all the time. So this is what I'm going to be requiring. Right, so what I do is I take that, I'm going to copy it, and I'm going to pull that through to our working because that's what I'm going to be calculating here. It's the initial investment. Okay, so that's the correct approach when looking at a question like this one. Okay, so that's what I'm going to do. Copy paste the formula. Right, this is for question 4, and then I need to basically fill in the blanks. Okay, so installed cost of the new. Right, so we need to look at the cost of the new machine. Okay, that was given in the question. If we go back, we now just need to pull the right information. Right, the new machine is going to cost $750 plus the 20 installation and the transportation costs of 5.
5, so 775.
Right, so this is how I would structure it if this was a written question. Okay, so yes, it's multiple choice, so if you wanted to, you can just do this on the calculator, but if this was a written question, you would have to write this down, and you'd have to fill in line by line by line if you're wanting to get all the marks. If it was written, I would even show workings as well, so the examiner can see what I'm adding here. Okay, I would even state that the 20,000 is for installation, and I would state that the 5,000 was for transportation.
100%.
Okay, but these are things that you would do if this was written. Okay, which it can be. In this past paper, I don't think they gave you
100%.
a question for initial investment as a long question. They asked you other things, but I'm obviously doing it the same way as I would if it was written. Alright, then you add the 2 and you would show this in your too many zeros here. Okay, that's better. Right, 775,000 is the installed cost of the new machine, less the after-tax proceeds from the old. Here we don't have to redo what we've done because we've got it. We can just reference figures from before. Okay, tax on the sale was 58. Well, plus 58 because it's a benefit. Negative of a negative is a positive. And then you would have that as your after-tax proceeds from the old.
258.
Yes, the formula says you need to less the after-tax proceeds. So it's this minus that. And then we've got to add or subtract the change in working capital. Right, so the best way to view this is in terms of cash flow. Right, so just to revise theory. Initial investment, is that an inflow or an outflow?
Initial investment is an outflow.
Correct. Okay, so if it's an outflow, it's seen as a negative. So now, if you look at the question said that we're going to be decreasing the working capital by 7,000. Is that an inflow or outflow?
It's an outflow.
Correct. Okay, so if it's an outflow, we're then going to include that here as an addition, not a subtraction. Does that make sense?
Yeah, because that just for me to get the sort of the theory around it right, those could be anything like an increase in inventory or anything along those sort of lines. So the decrease in working capital could essentially be that because this new machine needs more inventory, that you're spending 7,000 Rand more on inventory, and that's why your cash flow will be 7,000 Rand less.
Yeah, well, net working capital, just to give you the theory is current assets less current liabilities. So current assets could be your debtors, your inventory, your cash.
Yeah.
It could be any of those things. And then the same thing with liabilities.
Yeah, yeah.
Right. So
but generally, from what I remember is that if the one is positive or negative, it means, so for instance, in this one, it would mean that your current liabilities would have gone up by 700,000 Rand, effectively.
Well, yeah, because you would have had an outflow then, because you would have had to have paid for something, perhaps.
So if your working capital had increased by 7,000 Rand, it means that your current assets, things like inventory or something like that, would have possibly increased by 7,000 Rand as opposed to the negative side of it.
Yeah, possibly, but remember, if you're looking at something like inventory, an increase in inventory is actually an outflow, not an inflow.
Okay.
Okay, so be careful when you bring in other specific current assets.
Okay.
Okay, because, for example, if inventory increases, okay, that would have been an outflow, not an inflow. Okay, in accounting, they treat it the same.
Yeah. Yeah. Okay,
so
but I mean, isn't an increase in inventory and asset,
not an inflow?
Yeah, but I mean, if you're creating more inventory, that means that something you can sell. It's generally a current asset, isn't it?
It is a current asset, but do you see the cash flow consequence, though?
Yeah. Okay,
because
100%,
remember, we're not
perfect.
looking at accounting and accruals and things like that. So the one thing that I need to say now, because you've mentioned this, is be careful. With finance, no one cares about the accounting journal entries, because in finance, we just want to know what the cash flow is, because everything is looking at managing finance, not accounting for debits and credits. So that's the one big difference with a subject like this compared to accounting.
Cool.
Okay, so in accounting, when you did a cash flow statement in one of the separate modules, you would have seen that they would have spoken about movements in terms of cash flow. So, for example, if I buy inventory, that's an outflow in terms of cash flow.
Yeah.
All right, so there are different considerations. So we're keeping it simple here because it's finance, not accounting, but just bear that in mind, because sometimes they word it differently, and the wording of that could indicate a decrease or increase in cash flow. Here they just say decrease in working capital.
Yeah, the reason I'm asking that is because I've actually seen in some of the questions in the textbook, and stuff where they had an increase in inventory and stuff like that. So I just wanted to make 100% sure that I'm on the same page, just in case they do throw that curveball.
Yeah, I doubt they'll throw this or that curveball in this particular module, because what UNISA does with the finance is they split it. So working capital is actually covered in a separate module. It's FIN3702. FIN3701 is just, so the textbook that you've bought for this module is actually covered in 3 UNISA modules. It's 2601, it's 3701, and then whatever you haven't covered in those two, you cover in the last one, which is the 3702.
Yeah, 100%.
Okay, so you won't have to worry about the detailed cash flow. It won't be tested in this module. It's tested in a separate one.
Cool.
Okay. All right, so just literally take it for what it is. Sometimes they just decrease it as just minus and subtract, but normally you have to consider the actual implication in terms of the cash flow. Right, that's the correct way of doing it. But I've seen past papers, if you do it that way, in some instances, they don't give you the right answer, and then they actually interpret it differently, which is actually incorrect.
Yeah.
All right, so let's see how they've interpreted it here, and then we can comment. Okay. All right, so coming back to this.
Got your answer of 510.
Okay, so let's go back and let's see. We've got the installed costs, so we take this. Okay, we less the after-tax proceeds. Okay, and this working capital change,
we minus that as well.
Yes. Okay. No, you actually would have added it because it's an outflow. Okay. See, that's what I'm trying to say. Is it
why would
outflow?
Why would you have added it though? Okay, so you would add that.
But in terms of cash
flow, so where it
flow,
says decrease, so if it decreases the cash flow, it would be you actually add it to the less after tax proceeds.
Okay, just let me explain the theory, and then if you still don't understand it, then you can ask me your question. Okay, so the reason why I wrote outflow here, the initial investment is something that you spend money on. Okay, that's an outflow. Right, so it's an outflow because you're going to have to buy the new assets. Okay, when I have a change in working capital, the important bit here is to identify if the change is an inflow or an outflow. That's the important bit. Okay, if it's an outflow, then you would actually add that to the initial investment because more money is going out. Right, because then they're both negatives.
Yeah, okay.
Right, in the question, they only said that this was a decrease in working capital by 7,000. Okay, so a decrease in the working capital. So what they've assumed here is they've assumed that this was what? A cash inflow or outflow?
Cash outflow.
If they assumed it was a cash outflow, then they would have had to have added it, which is not the case.
Okay.
They would have subtracted it. So they're actually assuming that the decrease in working capital
so I had it right then. It was 510.
Is an inflow
is actually
of cash.
Inflow of cash.
Yeah, that's how they're assuming.
If it's a decrease in working capital, so if your working capital was 70,000 and a decrease by 7,000, you would have a working capital now of 63,000. So that would definitely be an inflow of cash.
Yeah, well.
So then the answer would be 510.
Yeah, it would be in this case, but again, it's not entirely correct because you need to consider the actual working capital movements. But because this is finance, not accounting, they don't go into as much depth. Right. So what I've seen what I've seen them do is they've literally just taken this. So here's the rule of thumb. If they say decrease in working capital, just subtract it. Don't worry about whether this is an inflow or outflow.
Okay.
Okay. That's what I'm trying to get across. It's not.
So what you mean is I basically added to the actual all the other inflows pretty much. So I would add it to the 258,000 and subtract that total amount off the actual initial investment portion.
Well, it's just a formula where you've got these three components. So this is what we're looking at. That'll either be added or subtracted. Okay, so having looked at the information, okay, if they say a decrease in net working capital, right, UNISA is just going to subtract it. They're not going to consider the cash implication.
Yeah.
Okay, which is fine. Okay, but that's not entirely correct, but it's what they're going to be doing. So they're going to subtract instead of add, and then you're going to get an option.
Okay.
Right, so
and
option
that would give us 510.
Yes.
Yeah.
Okay. Right, let's carry on. We've got new questions coming up. Okay, these are separate. They're not related to what we've covered now. Right, this is just theory, so theory should be quite easy to answer. We actually spoke about this. Common motive for adding fixed assets to the firm, expansion. Okay, adding to the firm's capacity.
Yeah. Okay. So if it says adding, it means expansion.
Yes. Expansion. Okay. Right, that's the common motive.
And if
companies have two motives.
And
replacement or expansion.
The other motive or expansion. Okay, 100%. Okay.
Okay. In terms of the most common, you'd be looking at expanding rather than replacing.
Okay.
Okay,
cool.
That's more common than
100%.
replacement.
Okay.
Right, using the information to answer the following questions. Okay, here you're going to need your financial calculator because they're asking you to work out this net present value. Okay, there's no need to do this manually. You're going to take your financial calculator, you're going to insert everything into the actual calculator, and you're going to solve. Do you still remember how to use your HP?
I do.
Okay,
I do.
You try work it out, I'll try work it out, and then let's put the answers for each one. Okay, let's start with Project S, stability. Okay, so I'm going to go to my cash flow, and I'm going to insert those values. Remember, you need a rate here. Okay, do they give you a rate? Yes, 11% is the cost of capital.
So cash flow 0.
Okay, have you got an answer for S yet?
Hold on a second. I think it's 34794.
Good, well done. That is correct. Okay, so the stability NPV is 34794.85088. Okay. Alright, so looking at this, they say NPV for the three projects would be closest to. So now we've got this. Okay, 35 is the closest. Okay, if you round it off. Okay, round it up, 35,000. Now we need L. Okay, so see if you can get L.
Yeah, L shouldn't be too bad. Sorry, I just needed to clear up in there. Now I've got 280,000 for the next one.
Okay, be careful. That the answer is actually 59,317.21278. That's the NPV.
Let me just try that again. So I do a negative 150 is the initial cash flow 0. Then there's 40,000, which is the first cash flow. 60,000, which is the second cash flow. 110, which is the third cash flow. 40 is the next cash flow. And then 30,000 is the next cash flow. I didn't put the 11% in. Okay, 59,317. That's what I did wrong.
Okay, and then the last one, you can double check it, but you should get this answer: 71721.91406.
Okay.
Right, so those are the NPVs for the projects. So then obviously we would be choosing option 2.
Okay. I got 97.
Ooh, no, something went wrong again.
Yeah. Okay, so it's minus cash flow 1. I don't think I put the minus in cash flow 1 or the cash flow 0. I'm getting to something completely different.
Okay, you need to put in the 0 as well, hey? So you need to put in negative 160.
I did put the 0 in.
Okay, then you put 100, 60, 0, 60,
negative 160. 90. Okay, so I put in 0, that 1, 0. Okay, that's where I think the problem was, is I put a double negative. Cash flow, then 60. 0, cash flow, 60. 11%. 71. Yeah, 71.7. I think I put negative
okay.
160 in.
Okay. Alright, but your option 2 is the right answer.
Yeah. Cool.
Okay, then we've got payback period. Payback period is also quite an easy calculation. You just need to consider the cash flows. Right, so if I look at the first project, I have an initial investment of 150. After the first year, I've paid back 50. After the second year, I've paid back 100. After the third year, I've paid back 150, payback period for the project is 3 years. So that's looking right.
Yeah.
Okay, the next one. 150 is the initial investment. After 1 year, I pay back 40. After 2 years, I pay back 100. Okay, how much do I want in the last year? Well, I need 50,000 of the 110, assuming that the cash flows occur evenly over the year. All right, so that would have been approximately 2.5 years, roundabout.
Yes.
Okay, so we can round it off to 3.
Yeah.
Right, and then the last one, obviously 100 in the first year, 160 in the second one, 2 years.
Second year. Yeah. Okay.
2 years to pay back, option 1. Easy.
Yeah. Cool.
Okay, you're just adding and you're looking at when do you receive all the money that you've invested. Right, 8 is looking at a profitability index. Okay, profitability index, just be careful, UNISA won't put commas for whatever reason. I don't know why they don't, but they should have. There should be a comma there. It's not 22, it's 2,2. Okay, it's 2.2. So 2.2 is the profitability index. The initial investment is 220,000. They want you to work out the net present value. Okay, so you go to your formulas and you get the NPV one. Okay, I just need to go get that from our notes. NPV. That would have been covered in week 3. Alright, so now let's find it. It's actually week 2. Week 3 was refinements. Yeah, week 2 is the right week. Okay, so if you look at the slides for week 2, you would have seen this on one of the pages. Profitability index is net present value plus original investment over original investment. Okay, so profitability index in this question is 2.2. 2.2 equals an NPV of question mark.
Okay, so equals an NPV
plus an initial investment of 220. Okay, divided by 220. Right, so there's the working. Then you need to do some mathematics. So take the 220 across, becomes multiply.
Okay.
2.2 times 220 gives me that. Equals that.
Yeah.
Solve for NPV.
So wouldn't you divide both sides by
Not divide, subtract.
subtract?
$264,000. Okay, again, I don't know why they just don't give exact answers. They always do this for some reason.
Yeah.
Closest would be 260.
Yeah.
Okay, option 2. Let's look at 9. A firm is considering 2 mutually exclusive projects. Okay, just to revise theory, mutually exclusive means I can only accept one.
One of the two.
Okay, project A, alpha, has a life of 5 years and an NPV of that. Project B has a life of 7 years and an NPV of that. The firm has a cost of capital of 10%. They want you to calculate the annualized NPV. Okay, so annualizing NPV requires you to use the PMT button on your calculator. Right,
Yeah.
so
Yeah. So we
annualized
would
NPV for A,
and
annualized NPV for B.
FB. So this is the one thing I remember is we would put the stuff down. So you do PV, I, NV, FB, and PMT just as a sort of precursor to what you're looking for.
Exactly.
Yeah. So you would take
400,606 is PV, 5
so
years.
you would basically take so for 1 and for 2, so your PV on the first one would be 404. No, that would be the NPV. Is the NPV, where does the NPV, is that the present value? The NPV.
NPV is the PV that you would use when annualizing the amount, because you're taking one amount and you're spreading it over a period of time. Okay, so what I've got here is the workings for the actual calculation. PV is the last one that I need. How much is PV for B? PV for B is 700,000.
Okay.
Right, so you insert the NPV as the present value because you're spreading it amongst 7 years because the project's useful lives are different. So annualized NPV is better. Okay, this is study unit 3. We're looking at the refinements when looking at capital budgeting. Okay, so payments.
Okay, so you're solving for payments.
The rate is 10%. The N is 5 for this one. The PV is 400606. Close brackets gives me an answer. Okay, that's what the calculator, well, that's what Excel gives me. And then let's do the other one. 7%, 700,000. Okay, it gives me that. Okay, so those are the annualized amounts. Right, those amounts, okay, if we're looking at the NPV, are the NPVs positive or negative? They're positive. So the answer here in terms of annualized NPV will also be positive. Okay, remember the calculator can't think. So the calculator will bring you a negative because if you insert a positive, it'll return a negative. Okay, so these are still going to be positive, okay, from an NPV point of view because you're still creating value, but you're just looking at the yearly amount. Okay, so I'm creating value at a yearly amount for A, 105, for B, 143. So which option are we going to choose? Option 2. 105, 6, 7, 8.
But the question, okay. But the better project you select would be B, though, because your annualized thing is 38,000 rand a year more.
Definitely, yeah. So obviously,
but according to the question, the present value,
yeah, the question was just asking you to choose the correct option, the correct answer in terms of what they've given you.
Okay.
Yeah, so there is no right annualized NPV for B. Okay, which statement is correct? So the statement that's correct is 2. Alright, number 10 is theory. Risk in capital budgeting. Okay, this is looking at cash flows. Right, so if I'm looking at cash flows, we can adjust for risk using 2 things. Okay, here they're saying risk in capital budgeting cash flows. Right, so we're going to be adjusting the cash flows. Right, we're not going to be adjusting the rate. Okay, so we're going to be using certainty equivalence. Right, because there's a probability that those cash flows aren't going to materialize. Right, so obviously cash flows that occur in the future. For example, net present value is taking future cash flows back in time. Cash flow 1, cash flow 2, cash flow 3, and so on, and so on, and so on. Okay. Are you going to have certainty with the initial investment? Yes. There will be 100% certainty with how much you're going to invest to start the project. Cash flow 1, you might be pretty confident with in terms of predicting. You might predict it with maybe 90% accuracy. Cash flow 2, maybe 80% accuracy. Cash flow 3, maybe 70%. Right, so as you go on in time, cash flow becomes more difficult to estimate or predict because no one knows what's going to happen in the future. Okay, so how do we adjust for risk when looking at cash flows? We build in certainty equivalence. Okay, it's bringing in probability, it's statistics.
Okay.
11 is a calculation. They say a firm is considering investing in a project with an initial investment of 1.5. The project is expected to provide equal cash flows of 400 over 5 years with a useful life. Risk index is 0.9. When you see things like this, okay, it's 0.9 and it's a risk index. So they're probably going to be talking about CAPM. Okay, the firm's cost of capital is 9%. Okay, that's cost of capital. Risk-free is 6%. And its RADR, which is the risk-adjusted discount rate, is calculated using that formula. Okay, they don't have to give you the formula. That you kind of need to know, because a risk-adjusted discount rate is just CAPM, but taking risk into consideration. Okay, beta in CAPM is your measure for risk. In your RADR, your risk index would be the measure for risk. So how much is the NPV of the project after adjusting for risk? Well, if I'm adjusting for risk, I need my RADR. Okay, that's something that you need to solve for. Okay, so risk-free, how much was the risk-free? 6%.
Risk-free, 6%.
Plus, the risk index was 0.9 times cost of capital was 9% minus the risk-free of 6.
Yeah.
Type that into your calculator to get an answer.
So is the beta coefficient effectively then the 0.9?
The 0.9 is the risk index, so it's slightly less risky than the market, basically.
Yeah, okay. But is that essentially like in the CAPM, because it talks about the risk-free rate times by the beta coefficient times by the risk-free rate minus the capital rate.
Yeah, but CAPM is CAPM. So the thing is, the risk-adjusted discount rate is similar to CAPM. The formula looks similar, but you don't use the market return. You use the cost of capital when you're adjusting for risk.
Okay.
Okay, because I'm looking at an internal calculation, not an external one. Okay, you're adjusting for risk in your risk-adjusted discount rate because you're providing for risk in your estimates for this project. Okay, because no one knows what's going to happen. Okay, so we provide for risk using scenario analysis, or we can adjust for the rate in terms of the percentage that I'm using to discount, or I can use certainty equivalence to adjust the cash flows. In this particular question, they're only asking about one refinement, okay, which is the risk-adjusted discount rate. Okay, there are 3 refinements in total. I haven't seen simulation. I haven't seen too much of scenario analysis. Scenario analysis has come up before, but it's normally as part of a longer question. Okay, RADR comes up quite often, and that's just adjusting the rate when discounting cash flows back in time. Okay, so now I've got the rate. Now I can discount cash flows back in time. What are my cash flows? Well, equal cash inflows of 400,000 over 5 years. So I can use payment of 400,000. Over 5 years, N is 5. What is the rate? I over Y is what I just worked out, 8.7. What else? Initial investment. Initial investment is 1.5. Okay, so obviously I want to work out PV first. So first calculate the present value. Okay, so let's work that out. PV open brackets, what is the rate? 0.087. What is my time? 5 years. PMT plus 400,000. No future value, close bracket equals. There, that's it. Alright, so the present value of those cash flows taken back in time, okay, is 1568.0 0.047. Okay, those cash flows are positive. So this would have been a plus, not a minus, actually, because we're looking at the present value of those future cash flows. So this would be the total inflows at time 0.
Okay.
Okay, then I less the initial investment. NPV equals initial investment minus the present value of your future cash flows. Right, we've done this before when we looked at time value of money in FIN3601. Okay, NPV is just a calculation where you compare your initial investment to the present value of your future cash flows. Okay, so obviously if I take this and I subtract 1.5 mil, then I get 68,04725, option 1. That's good. The exact answer is there.
Okay.
Right, next is theory. Which of the following statements is correct? The only source of capital that has to have its risk, it's adjusted. Sorry,
can we just go back? Can we just go back to the last one quickly?
What about it?
Just your working out. Okay, I understand that 5. Okay, so that's what we calculate. So the 1,568 is what we calculated that. Then our initial investment was 1.5. That's how we got to the 6,047. Okay, no problem. I just was a little bit lost there.
Okay. Happy?
Yeah, 100%.
Right. Okay, 12. The only source of capital that has to have its adjusted for tax is the cost of debt. It's what adjusted for cash? It's what? I don't know what, but it's probably its cost. I think there's a missing word here. The only source of capital that has to have its cost adjusted for tax is the cost of debt. That would be correct.
Yeah, and that would be because of interest.
Because interest is tax deductible, yes.
Deductible, yeah.
Okay, but let's check the others. Okay, the weighted average cost of capital can only be found by weighting the cost of each specific type of capital by its proportion in the firm's targeted capital structure. The weighted average cost of capital can only be found by weighting the cost of each specific type of capital by its proportion. No, but then you need to multiply it by its cost, times the cost.
Okay,
because it's weighting times cost, weighting times cost, weighting times cost. Yeah, so they're forgetting about the cost side. A breaking point is the level at which the cost of all the financing components rises. It's not all, it's the individual ones, so that's out.
Okay.
The smaller the differences between the internal rate of return and the weighted average cost of capital, the larger the resulting NPV. That's false. Okay, the bigger the difference, alright, the bigger the NPV. Alright, so number 1 is true, but number 1 is looking for a missing word. It should be the only source of capital that has to have its cost adjusted for tax is the cost of debt.
Okay. Cool.
There's a missing word there.
Yeah.
Okay, because what are we adjusting? It must be the cost. Okay. 13 is theory. The rate of return that must be earned on investment projects in order for the firm to maintain the market value of its shares is called cost of capital. If you generate a return, an IRR, which is equal to your cost of capital, you're not going to deplete or you're not going to add value. You'll just maintain the market value of those.
Maintain the value. Yeah.
Yes.
Yeah. Okay. It's the same as if the net present value equals 0.
Basically, yes. Net present value would be 0 because you're not adding any value, you're not destroying any value. Correct.
Yeah, but you would still accept the project though, because you still get accepted rate of return.
Yeah, you could, because you're just making the pie bigger, but you're not adding more.
Yeah, but I mean, so just to get my understanding right about this, so if the internal rate of return matches what the internal or what the required rate of return is, essentially. So if it's shares, and the shareholders want 12% back, and you put in 12% and you get to basically the same as the cost of capital, and the same as with the net present value. If you put in 12% and you come to zero. So in the textbook, they say any project that's zero or above, or that has the internal required rate is the same or bigger. So if the internal rate required is 12% and it's 12% up, you would accept the project, all things being equal.
Yeah, you would, definitely, yeah, because the thing is, your internal rate of return is just a measure of your expectation in terms of value that's being created over the life of the project. And if that's equal to cost of capital or the required rate of return, that project would be acceptable, yes.
Yeah, okay. But then if you were looking at different projects, you would obviously look for the one that had the highest internal rate of return or the highest net present value.
Definitely, yeah. Net present value is actually a better measure. Yeah, if you remember back to FIN3601, NPV is the best measure because it looks at the actual value that's being created versus IRR, which is just a percentage.
Yeah, but don't financial managers prefer the IRR though? I know there was a question like that in one of the...
Yeah, they do.
In one of the things about it.
Yeah, they do, because for them it's IRR is a rate they can compare. But remember, I mean, you could have an IRR on a small project. Let's say the small project costs 100,000, and you get an IRR of 20%. Okay, 20% of 100,000 is 20,000. Okay, but I mean, you could have a project for 10 million. Right, and you could maybe earn 5%. 5% on 10 million, okay, is, I think, 500,000. 500,000 in terms of its value is greater than 200,000.
Yeah, I was just looking at something. So question 8 in that exam that you did, the October-November, it says, in comparing the internal rates and net present value methods of evaluation. So what financial managers prefer, financial managers, the net present is theoretically superior, but financial managers prefer to use the internal rates of return.
That's correct, yes.
And I do remember, yeah.
That's right.
Yeah, I do remember reading that. Okay, no, just because we were talking about that, I just wanted to confirm.
Yeah. No, that's 100% correct, yes.
Okay, cool.
Okay.
So it is. So the managers prefer the IRR, but NPV is actually far superior.
Yes, they prefer it because it's a rate that they can compare, but NPV is always the best.
Okay. Cool.
14, Nigel has a beta risk-free market return. What is the risk premium of the market portfolio?
CAPM.
Okay.
So this should be CAPM, definitely.
Pardon?
Yeah. This is definitely CAPM.
Definitely,
That's what I think.
Yeah, so with CAPM, obviously, if you're looking at the risk premium, okay, the risk premium is the market risk rate minus the risk-free. So what is the market rate here? 7. 7 minus the risk-free, 2.5. Is 4.5. That's the answer.
Okay. What about the beta coefficient though?
Pardon?
Where does that come? What about the beta?
The beta is used to get the market risk premium.
Okay.
Okay, so if you're wondering about this, the textbook reference is page 325. They discuss it at the top of the page in the first paragraph.
Yeah. Because what is the actual formula for CAPM? Because isn't it the risk-free rate, or it's a risk-free rate, and then there's a bracket with the beta, which is times by the risk-free minus the market rate.
Yeah, required return, risk-free plus beta times the K market minus the risk-free.
Okay. Yeah. Free.
Okay.
Yeah.
So,
okay. Yeah.
So this is called the risk premium.
Yeah. Okay.
This whole thing here is called the market risk premium. They're two different things.
Okay.
Right, 15. A firm has ordinary shares with a market price of 90 Rand and an expected dividend of R5 per share. Dividends paid on ordinary shares over the past 3 years are given below. There's it. Okay, they want you to work out the cost of ordinary shares. Okay, you can use the formula that's in your textbook, you can use the formula in my notes, or you can use Gordon growth. Either or, they all work out the same. Okay, so I'm going to use Gordon growth. PV equals div1 over brackets R minus G. Okay, you can use the other equation that the textbook gives you. The other equation is R equals, and then they give you the formula. Okay, because they've just derived R as the subject of the equation. It makes no difference how you do it. You get to the same answer. It's easy just to remember one equation and just use it time and time again. So Gordon growth you should know by now from FIN3701. They also use that. So a firm has ordinary shares of the market price of 90. 90 equals dividend 1, expected dividend of 5 Rand next year. So that's div 1. Div 1 is 5. Divide by, open brackets, the R minus the G. The R is what you're looking for. The growth is going to be calculated looking at this.
Yeah.
Okay, so G, you're going to have to solve for G. Okay, so how do you do that? Well, simple. PV was what? What did I start with? 3 Rand 20. FV, 4 Rand.
Okay.
How many ends do I have? 2. Okay, from this year to that year, 1 year. 2 years. Solve for the rates. Okay, the rate equals 2 years, no payment, present value of minus 3.2, future value of 4. That's what I get, 12%. Well, actually, let's put more decimals. That's what you get. Okay, then we need to insert that into our formula here. So that'll be 0.118034 dot dot dot, close brackets. Right, take the R across, becomes multiply. $90R $90 times negative, let me actually use this, times that, no, that's a percentage. Okay, that won't work. Okay, so let's just do it. 90 times negative 0.118034. Okay, oh, that actually did work. Negative, let me just undo that. Yeah, that actually did work. Okay, good. Okay, equals 5. Alright, so then what do? I take this across. I'll have 90R. I'm just doing mathematics here.
Yeah. No, 100%.
Okay, 5 plus.
Okay,
gives me that.
plus minus.
R equals. Okay, that. Times it by 100 gives me a percentage. 17.35%. Option 4.
Okay. Cool.
Right, so it doesn't matter what formula you use. I just use Gordon growth because it's the easiest to remember. If you want to remember the other equation where R is the subject of the formula, then that's fine. Okay, you can, because then you substitute everything in and you can work it out in one step. Alright, for me the maths isn't difficult, so for me to play around with the brackets and the timesing and dividing doesn't really make it difficult, so I just prefer to remember it that way. But you can decide. If you want to remember the R equals, it's in the notes. Maybe just to show you that. Let me just find it. It was.
Anthony, will you be able to send me? Will you be able to send me the workings out at the end of this, so that I can just go through it tomorrow again?
The Excel stuff that I'm using now, you're going to get. Yeah, so whatever I'm doing on the board now, you'll get this via email. So don't stress.
Okay, cool.
Okay.
Cool. Yeah, I'm not saying the whole video yet. If I can just have this, because it'll actually, then I can go just spend a bit of time and just go and look through it tomorrow.
No problem. Yeah, no problem. Okay. Right, 16 is theory. Since retained earnings are viewed as fully subscribed issue of additional shares, the cost of retaining the cost of retained earnings is. Not related to the cost of new ordinary shares, that's false. Greater than the cost?
Equal.
No. Less than? No.
Equal
To the cost? Yes. Okay, that's assumed
Yeah.
because they're saying, well, if you're not going to have to issue new shares and you're using retained earnings, well, the thing is that profit would have been paid out, then you would have to have issued the shares anyway.
Yeah.
Okay,
but it's also that also relates back to that if you're going to use that as the capital in order to invest in a new project, as the cost of capital.
Yes.
And the shareholders wanted 12%, that you would automatically use the 12% as because if they want 12% return on their shares that they have, and the retained earnings equals to shares, means that if you use retained earnings to fund a new project, that 12% would be what your internal rate, your required rate of return would be.
Yeah, there are different ways of getting to a cost of capital, because with cost of capital, it is a slightly more, how can I say, subjective measure that you could get, because, I mean, your shareholders may want a ROE, and you could say, well, that could be my cost of capital. But then if you look at the amount of dividends that you pay out, the dividends could be your cost of capital. So it all depends. There is economic and finance theory that covers it. So, for example, if I just talk about like Miller and Modigliani, they're just one of the economists that did some workings around this concept, where they looked at this whole idea of costs and costs specific to equity. So with equity, it is slightly more difficult to value equity, because remember, with equity, there's an indefinite time period, because people can hold shares forever. And we know it gets more difficult to predict value in the future. Yeah, but you can assume that those shares are equal to the cost of the new shares. But in reality, it's actually slightly more than. Okay, because, well, actually less than. Less than. Because if I issue new shares, normally shares are issued at a discount because people need to subscribe for them.
Yeah. Okay.
Yeah, so in reality, there are different considerations. But if we're just looking purely at textbooks, in terms of the textbook answer, the textbook answer would be 4.
Okay. Cool.
Okay, equal to. That would be the textbook answer.
Okay.
$17 is a calculation. High Tech has pref shares. Pref shares pay out a dividend. It's currently trading at 30 Rand. It has flotation costs of 2 Rand 50. The company pays a regular dividend. If they pay a regular dividend, the dividend is continuous in terms of period after period after period after period, forever. Okay, 2 Rand 52, and its expected EPS is 7 Rand 20. Calculate the cost of the pref shares. Choose the correct option. Okay, here, if you want to, we can use the exact formula that's given in the notes, which I'm going to do now, just to show you a slightly different way of working it out. Let's find that here. Where's my formulas? Okay, that's, I think it was 4. Yes, cost of ordinary shares. I want pref shares. Okay, in the notes, you have a formula for the preference shares. Where's the one with the net proceeds? Here's it. Cost of pref shares. Okay, so one of the notes give you this. It's in the textbook as well. You can refer to it as well. It's up to you, but this is what they use to calculate it. So the I, which is the interest, equals, or the rate, equals the payment over the PV. So rate equals, how much am I paying? Let's go back to the question.
It's 252, isn't it?
252, exactly.
Yeah. Okay.
Divided by open brackets, net proceeds. 30
so the
Rand
rate is basically the dividend.
2.5.
Rate equals the dividend.
What about the dividend?
The rate would be the dividend.
The rate would be the dividend, basically, yeah, but the dividend over the net proceeds. 30 less 2.5% of 30. Okay, that's the answer. 8.61%. 8.61%. 8.61%. Option 1.
Okay.
18.
So what is the cost of preference share? I mean, what does the cost of preference share mean?
The cost of the preference share means if you're going to be raising equity through pref shares. Okay, remember, this is a cost of capital debate in terms of how you are going to finance your company, your business. Right, so are you going to raise equity through ordinary shares, or are you going to raise equity through pref shares, or are you going to raise equity through an issue of bonds? Right, so companies decide on where they want to raise equity. They can either raise equity through debt or equity, either or. Right,
but
so if they choose...
So it's the cost of it is 8 point... So effectively that would be the interest rate, is the 8.62%.
Not the interest rate, the cost of raising capital through the issue of pref shares.
So what I'm just trying to look at it as, if we were saying that... So if we were looking at three different
sources of finance.
Well, let's just say three different projects, okay?
Fine.
And we were measuring each project by whether it had an internal rate of return of 8.62%. That's what we're pretty much looking for. Because that's what the cost of this is. So if we had one that had 8.62%, that project would effectively be feasible. But if we had two projects where we could only choose one, okay, and we had one that had 8.62% and we had one that had 9%, we'd go for the one with 9% because it's actually a higher rate of return.
Yes, because the cost, but that's assuming that project A, B, and C are being financed through the issue of preference shares. Okay, so here's what you're saying. You've got three different projects that require capital. All right, let's say those projects require $1 million each in terms of capital.
Yeah.
All right, so if I need $1 million for each project, okay, and what sources of capital can I look at? Well, I can sell shares in my business and I can raise equity through ordinary shares. If I've got retained earnings of 3 million, I can accept all three projects. If I'm going to be issuing preference shares, which I'm doing here, then those preference shares are going to carry a cost of 8.62%.
Cool.
That's what you're basically saying. Right, so if I'm going to be financing or raising funds through an issue of preference shares, I'm going to require a cost of 8.62% in order to raise that capital. And then that capital will be invested in A, B, and C.
You would also possibly require...
If A has an IRR of 8%, I'm not going to accept A because the benefit doesn't outweigh the cost. If B has an IRR of 9%, I'll accept. If C has an IRR of 8.62, I would accept. Okay, but see, that's bringing the decision making into it. Okay, right now, they're only talking about the cost of one form of capital.
Yeah. No, but
is that alright?
Or if the capital cost us 8.6%, okay, we would have to look at least getting a return of 8.62% in order for the project to be feasible.
Yeah, minimum, as long as you're only looking at preference shares in terms of your source of funding.
Yeah, no, 100%. Yeah.
Okay.
Cool.
Right, but remember, this is not the only source of funding. If you do bring other sources of funding into it, then you've got to look at a weighted average cost.
Right. Which could be your thing cost could be 10%, your other share cost could be 8%,
that type of thing.
And you have to wait the cost of you'd be No, I understand it. I'm just trying to link it back to say what this cost relates to.
Sure. That's good. Okay.
That if we're using that one source of capital, that we would need a minimum of that rate of return in order for that project to be feasible, or a project to be feasible.
Exactly, yeah.
Okay, cool.
Having raised the finance to that source of funding.
Okay, 100%.
All right, B Investments has a coupon, 7%, matures in 20 years, selling for that par value of 1,000. This is something that you would have worked out in FIN3701, the cost of bonds, okay, debts. Right, so all I'm going to do is identify values here. Right, 7% coupon is 7% of 1,000. PMT.
Yeah. So the 7%, that's exactly where we'd come back to where you do your payment, where we do the payments, and where we do the PMT, we do the PV, the I, the N, and the
20 years.
Yeah. Okay. So we'd have N equals 20, PMT
is 7% of 1,000. Your PV is 985.56. 985.56.
Okay, and your future value would be 1,000, wouldn't it?
Yes.
Okay, perfect. Yeah, these are the ones that this is the one that actually always gets me, is solving for the I.
Okay.
What did you say? Okay, so it's 985.65.
Yes, negative. PV is your initial investment.
That's what I always do. Is I don't do the negative, and that's why I never get it right.
Okay.
Okay. Let me just. Okay. So we've got 70 as PMT. We've got 20 as N, and we leave it for 1 for N because there's 1 N per year. It's not like it's every 6 months or whatever.
Yeah, it's every year. They didn't say this was semi-annual. If they said semi-annual, then I would have to do that.
Okay,
they didn't say. They said annually.
Okay, and then your future value is 1,000.
Yeah, you get 7.14, option 4.
Okay, and then what? Okay, so I've put it into the calculator. I'll put PMT equals 70. I'll put 20 equals N. I put 985 negative, the 985 as a thing, and then I put the future value as, oh, no, wait. Let me start that again. Okay, so I'm putting 20 as N because that's your 1,000 as your future value. I'm putting 70 as your payment, and then 985.65 or 56 is your present value, and then I just push the IY button.
Yes.
So interest per year gives me no solution.
Ooh, then you made the mistake. Clear the calculator, start again.
Okay, that's what you see, this is where I have the same problem with this every time. Okay, so 70 is payment, 20 is N, and I've checked that it's on one payment per year. PV is 985.56 minus, that's probably what I didn't do again, that's present value, and then it is 1,000 for future value, and no, it still gives me no solution.
What minus button are you pressing?
No, I'm pushing the wrong minus button, that's why.
Are you pressing the plus minus one? Or the minus or the bracket? I think that's a minus in the bracket for the HP.
No, it's a plus minus button.
Plus minus. Okay, that's the button. Yeah,
that's exactly. Just give me one more second, because this is the one thing that gets me stumped every single time. But I think I know why now. Present value, 1,000. Future value. Yeah, 7.1377.
There we go.
Cool. Okay. Now I've got it now.
Okay, 19 is looking at which project would you choose. They've given you everything here. You're just looking at the details in the question, and then you're making a decision. Right, so a company with an optimal capital structure of 33% debt with an 8% cost, 14% cost of equity. Okay, that's what they've given you. Right, that's important because now I can work out a WACC.
Yeah. So
okay,
this would be a way. Okay.
Okay, so weighting of the one times the cost, weighting of the other times its cost. Okay, so if I'm using 33% long-term debt, that means the equity would be how much? The remainder, right?
Yeah.
67%.
Yeah. Okay, so the debtor's obviously got the after tax because you get the tax benefit on the interest portion of it.
Yes. Here they said it was, there's no tax here because it didn't give you a tax rate. So you can't assume 28%. So you would actually leave it out. You don't have to worry about the tax. You can just leave it as 8%. Yeah, but if there was a tax rate, you would have to put it in.
Okay.
What is the cost of equity? 14.
I think so. Yeah.
%12.02% is the WACC. Okay, so now I've got 12.02%, which is my weighted average cost of capital. Right, so will I accept A? Yes. Okay, they said mutually exclusive, so I can only accept one project. I wouldn't accept B, I wouldn't accept C or D because all of these internal rate of returns are less than 12.02.
But I mean, even if it wasn't mutually exclusive, you wouldn't accept more than one of them.
Exactly.
You would only accept the one with the one above 12.02.
Of course, yeah, it's mutually exclusive, so only one project can be acceptable.
Yeah, but I mean, if it wasn't mutually exclusive, if you could accept more than one.
If it was independent, you could still accept only one, yes.
Yeah, because the others are all below what the weighted average cost of capital is.
Correct.
Cool.
Okay, last question in terms of multiple choice. Company has a fixed operating cost. You've got SP, selling price of 25, VC, variable cost of 15. They want the operating break-even point in units and rands. Okay, so this is where your formulas come into it. So BEP in units equals FC, which is fixed cost, divided by open brackets SP minus VC. Okay, that you study, that you remember, then you write that down and you get an answer. Okay, so the fixed costs were how much? 10,000. SP of 25, VC of 15. 10,000 over open brackets 25 minus 15 close bracket equals. Answer 1,000 units. If you want break even in rand, you times it by the selling price.
Yeah. Cool.
25,000. So 1,000 and 25,000, option 1.
Yeah.
Alright, so you can see that UNISA has done a much better job at managing this particular module because besides one or two minor like errors or omissions in terms of information, everything else was fine.
Yeah.
Right, so things have improved quite a bit compared to previous past papers. I mean, we've seen some really bad ones in the past. Luckily, things are much better now. Okay, so I don't think you have to worry or panic about errors. It's looking good considering this is 2017. So unless
I think some of the subjects, some of the other subjects have taken over though, because so I had an exam on Friday.
Yeah.
Where the guys had a case study where the case study didn't speak to 90% of the stuff that they wanted as practical examples.
Ooh, wow. Yeah, that's not good. Sure.
Yeah. So,
All All right, but yeah, I mean, this module looks a lot better now than it was before. So yeah.
Yeah.
Okay, I think Jeb, let's
Cool.
take a quick 5-minute break just to refresh before we jump into the longer questions.
Yeah.
If that's all right with you?
100%. Yeah, cool.